Monday, June 1st, 2020, Maneco 64, home of alternative economics and contrarian views. So, the silver train is moving very fast. Silver's continuing to surge higher this morning. The gold silver ratio is continuing to gap lower even this morning. Billy is very happy, of course. He's very calm. He's always calm because he knows what silver really is. Silver's money. It's argent. It's plata. It's sterling, right? So he knows his history. He knows what money is all about. So I'm going to cover the silver market this morning here briefly, also the other markets. And then I also want to talk after that a little bit about the Keynesian fallacy, and you'll see what I mean when I talk about it. So let's quickly go to the markets. It's just before 8:30 a.m. London. So spot gold is up as well, but not as much as silver, of course, and that's why the gold-silver ratio is continuing to deflate. I said yesterday in one of my videos that I think that ratio is going very quickly towards 80. Anyway, gold is at 1740, up about 11. The high's been 1745.70 and the low has been 1725 overnight. Silver is up about 45 cents or 2.4% at 1830. The high's been 1840. I think, yeah, we'll be at 20 very soon, if not at the end of this week, but maybe next week. What else? Well, with all that's happening in the U.S., the strife, the social unrest, one would have thought, of course, that the stock market would be lower. And it was earlier. We were down about over 300 points in the Dow futures, but now we're up 166. It's just another symptom of what's wrong with America, I think. The top 1%, they run things. They manipulate the markets through the Federal Reserve and through the U.S. Treasury. They bailed out Wall Street again. They started the bailout back in September when overnight repo rates went up to 10%. Keynesians, and I know I'm going to address Keynesians later, but Keynesians think that the interest rates we have now in treasuries and in government bond markets is something to do with a savings glut. I think they're full of it because if you look at the chart of the U.S. 10-year yield back in 2018, the Federal Reserve tried to normalize policy. They did lift interest rates. They did do a quantitative tightening. And the 10-year yield, as you see, got almost back up to 3.5%. But then they saw that the whole house of cards was going to implode. The stock market was going to collapse. And Jay Powell was scared of losing his job because even though President Trump said that Obama had blown a big fat bubble in the stock market and that Yellen had helped him with low interest rates, he also thought it was a good idea to have an even bigger bubble. He even thinks it's a good idea now to have negative interest rates. So please wake up. President Trump is not looking after the American public. He's looking after the 1%. I know I will get a lot of criticism from this, but yeah, I look at the numbers. I look at the facts. So this is why interest rates have dropped so much, because the Federal Reserve is manipulating the bond markets, and that moves interest rates lower. They've printed like 3 trillion in the last few months. No wonder interest rates are so low. No wonder the stock market has rebounded. So it's got nothing to do with fundamentals of the economy. And that's why all fiat currencies, not just the dollar, are melting down. And it's going to get worse socially, I think, because the very top, the top 1%, the top 10%, they've got the wherewithal to withstand the meltdown of the fiat currency or the fiat dollar. the people out there in the general public, the bottom 50 and even 90%, they're going to be hard up. They're going to get angrier. So let's continue with the market. So I guess you could have extraterrestrials land on the Rose Garden and the Dow would go up. S&P futures is up 0.5%. The currencies, we're seeing the dollar weaken here a little bit, not much. The pound is up 0.4% at 124.03. The euro is up 0.25% at 111.34. And the dollar is down 0.25% versus the yen at 107.56. Oil price is steady. WTI is at 35.46. And back to the bond market, the 10-year yield, we are at 66 basis points. So that's not a sign of a good economy. The Fed thought the economy could do well, thought that it could withstand higher rates back in 2018, and it tried, and it realized that it was bringing everything back down again. The stock market was under pressure, so it reversed everything. So it's got nothing to do with savings gluts or demographics. It's all to do with the central banks manipulating the market, and the Keynesians, of course, as well, because everyone out there in politics and central banking, they're all Keynesians, even President Trump, everyone. Well, Richard Nixon said it back in the 70s. We are all Keynesians now, and they've remained Keynesians since then, I would say. So what is the Keynesian fallacy? Well, to sum up, it's very simple. The Keynesian fallacy is that the markets don't know better, that the politicians and the elites know what's best for markets and the economy, and that they need to intervene to help the market. We know that the market is the best mechanism for allocating resources in an economy, and prices, of course, regulating prices through the mechanism of supply and demand in a free market where people act not forced by government, but voluntarily. That's the best way to have a market. The booms and busts will happen in a free market, but they won't be as bad as when government intervenes and redistributes wealth forcibly to sectors that don't deserve to be in business. And that's what makes booms and busts even worse when you have a central bank, which is not a free market institution. It's a monopoly given its power by government, and it's got nothing to do with free markets. So that's what happened. The booms and busts get even worse, and they keep trying. So yesterday there's a story out in the FT. Rishi Sunak set for July stimulus package to stave off recession. So this guy is the UK Chancellor or Minister of Finance, or equivalent of the Mnuchin in the US, Secretary of the Treasury. So the fallacy is that they think that government knows best. So they're going to take wealth from those who still have some wealth, despite all that's going on right now. Health crisis, the new crisis evolving in the States, all the debt that has been issued into the system, all the money printing by the Federal Reserve. There are still those who have some wealth. So what this guy wants to do, he wants to punish these people who have been careful and have been able to save the wealth, take their wealth, extract it from them, and allocate it to people who haven't been successful. How does that make sense? How is that going to stave off a recession? And it's not only here in the UK, it's also in the US. I spoke to Mike from Rethinking the Dollar this weekend, and he was telling me that Congress is looking for even more stimulus, despite the fact that President Trump signed into law $6 trillion in debt for the American public, for future taxpayers. That was the biggest Keynesian injection, and I don't hear any criticism of that. I see the headlines on X22 report, which I don't watch anymore, and he's getting loads of views. Is he telling you what's really going on? He's saying that the economy is doing great. Is he looking at the debt? Is he looking at the national debt, the 25 trillion that is racking up at a rate of knots right now in the US and in the UK as well? Our debt is racking up. Budget deficit in the US of 20%. Well, it might be part of a plan by Trump to bring these people down, but I'm sorry, we've had these kind of plans, and things just keep getting worse for the general public. They are getting better, of course, for the 1%. They are benefiting from these bailouts. So, yeah, that's the fallacy. The fallacy is that they know best, that the market can't be trusted. And that's why we are in this situation where markets don't make any sense anymore, because our countries, our economies, our monetary systems are being run by these people, these Keynesians, who think that a few guys in a boardroom at the Federal Reserve, FOMC committee, or the MPC at the Bank of England know best that the market can't be trusted. I have to give Paul Volcker a little bit of credit, because he was the last central banker who allowed the free markets to decide interest rates. That's when he allowed the market to take the short term, or the discount rate, I think it was, up to 20% in the US. That was in 1980, 81, that period. And we saw the 10-year yield go up to almost 16%. But nowadays it seems like these people are scared to let the market decide things. And it's understandable why they're scared. The reason they're scared is because they know that the house of cards on Wall Street is going to collapse if they allow markets to be real. All this wealth, or phony wealth, that's been pumped into the stock market, it is not real. And interest rates would see to that. Yeah, so it's a screwed up world, I think, where the most important thing for the establishment, for the people who run the countries, especially the US and the UK and Western Europe, is to maintain a facade of financial health, to say, oh, look, the stock market is doing well, so everything is fine. That it's just a Potemkin village. There's nothing behind the facade of the stock market. And that is the problem. That is the Keynesian problem. We need to go back to less government, freer markets. That will promote less corruption, I think, in my opinion. Of course, the world will never be perfect, but we can move towards a more perfect world and abandon this Keynesian fallacy. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Facebook, Twitter, and all these other platforms below here. I wish you all a great day. Take care. Bye.